Hello, my dear friends. This is your friend Vivek Bajaj, co-founder StockEdge and elearnmarkets. नमस्कार दोस्तों, मैं हूं आपका मित्र विवेक बजाज. Today we are going to have another face-to-face global, and this time another star is going to present his thought process, his understanding of the market, his style of the market, and we're going to learn so much today. So, guys, who you have been a great supporter of my work, so I hope you are going to keep supporting me like this. As we go global, as we cover more stars there, we are learning so much from each one of them. And today's star is amazing. I've been following him for some time. His understanding of charts is super. So for people who have decent understanding about technical, you're going to learn so much today. And for people who have no understanding about technical, don't worry. This is a great warm-up for you to get a perspective about trading and technical and multi-market understanding. And then probably you can learn technical as well and see how his study is useful for you in your trading career. So let me welcome the guest for this face-to-face, JC Parets. Hello, JC.
What's up, Vivek? Nice. Thanks for having me.
Thank you so much for giving your time. And I'm very excited to record this one, very honestly.
You mentioned, technical analysis and using history in order to help us make decisions in the market.
Yeah.
And it's probably a good place to start because a lot of times people are like, well, JC, technical analysis only looks at the past. And it's like, well, if you can give me information from the future, I would be happy to take a look at that. But for us mere mortals who don't have superpowers to go into the future, we have to look at information from the past.
Yeah.
That's the case whether we're using technical analysis, fundamental analysis, whether we're economists, if you're looking at the moon and the stars, which I know some people do. All of that is information from the past. So I think it's a good place to start that's not necessarily something that is about technical analysis. That's just what we deal with as investors.
True. So your interaction or your engagement with technical analysis is how long? I mean, since how many years you have been practicing this?
We're going on almost 20 years, Vivek. It's been quite the journey. I would say many ups and downs, and it's a combination of market participation. Actually entering trades, options trades, stock trades, futures transactions, ETFs. You name it, forex. I mean, I've crypto, right? I've traded it all, and that has been a great learning experience for sure. Not to mention the conversations that I'm very fortunate to have with investors all over the world. I know you've had Jack Schwager on this particular podcast, and I have had Jack Schwager on my podcast, and I've read all the Jack Schwager books. And if you're out there, you're listening, and you haven't read all the Jack Schwager books, then as soon as you're done watching this video, go read the Jack Schwager books. And as soon as you're done reading them, read them again.
Yeah.
And just with my travels, not just in America, obviously I've given maybe not obvious, but just so you know, I've given a lot of presentations around the country, New York, Miami, Chicago, San Francisco, Dallas, right? I mean, just your usual suspects of where Vancouver, Toronto, but then, in Asia as well, Hong Kong, Singapore, Kuala Lumpur, Manila, Taiwan, Mumbai 3 times, New Delhi, and then all over Europe, London, Amsterdam, Athens, Paris, Dublin, and throughout all of those experiences, for me to go up there and talk about the charts that I look at every day and that I talk about every day, for me, that's the easy part. Where I really truly win is in the conversations that I'm having afterwards, at the party, in the backyard, in Mumbai, with the band playing, eating plenty of good food and having conversations with people there, drinking the sula, right? That's really truly where I've learned the most, I think, with the people.
I mean, 20 years. So, I mean, you have been there, done that. You have seen the evolution of technical analysis as a subject. Which year did you form your company, All Star Charts?
So I started the company All Star Charts in 2012. So 10 years ago, I started All
Okay.
Star Charts. It really started off as just a blog, just a way for me to share ideas. I recommend this for every investor to write it down, put your thoughts on paper. Why are you buying the stock? Why are you selling that stock? What else is happening in your life? Did you get in a car accident? Did a family member pass away? Did you just get a raise at work or a promotion? Like, what else is happening in your life? And you're going to be able to go back to your journal, in my case, a blog, and you're going to be able to see what was going on in your life, what you were doing, why were you having success, why were you failing? And a lot of that, I think, has to do with what's going on around you. Blogs are a relatively new thing. They've been around for 10, 20 years, but journals have been around for centuries, right? Kings and philosophers, and they've all kept journals. So, we call them blogs today, but we've had them forever. And obviously our predecessors found value in them, and I do as well. So whether you share it with the public or you keep it private, I encourage everybody to write. So that's how the blog started. In 2016, it turned into a formal research company. And now we provide technical analysis research for, pretty much every major bank you've ever heard of, a lot of major hedge funds that you're very familiar with, a lot of the market wizards in Jack Schwager's books are clients of ours, and then a lot of financial advisors and individual investors as well, investors that are first opening up their own accounts, learning how to trade. So we get all kinds of perspectives from new investors to the most experienced, biggest investors of all time and everybody in between. And the back and forth and those dynamics, truly is a blessing. I'm very fortunate to be able to have conversations with all kinds of investors from all countries around the world.
Nice. So if I have to ask you, after how many years of practicing technicals, because you have been in this industry for 20 years, after how many years you felt that, yes, I think I know this science and I can use this science?
Yeah, I still haven't gotten there, Vivek. It's always a learning. It's always a work in progress. If you think you have it figured out, you still got a lot of work to do. I think the real wisdom is that you're never going to figure it out. The markets are always changing. The markets are always evolving. We always want to keep learning. When you enter a trade and you're successful in that trade, rather than dancing and, celebrating, I think it's important to go back and see how you could have done better, right? Because if you're so smart and you made so much money, why didn't you have a bigger position on, right?
Sure.
Right? Like, there's always improvements to make. When you book a loss, instead of crying about it, why don't you go back and see what you did wrong, what you could have done better, to book a smaller loss maybe. So there's always a lesson, whether you're successful or whether you fail, there's always a lesson there. And it's up to us as investors to learn those lessons and be able to improve. And a lot of investors choose not to do that because they'd rather celebrate the good trade that they made, the good trade, when the truth is it probably could have been better.
True. So, a lot of people in India, because Indian market is now evolving with massive participation from retail. And there'll be some people who would like to aspire to become a JC of India. Now, I want to, I have so much I can discuss with you, but I want to touch this point that if someone has to make a career as a technical analysis practitioner and have B2B clients or B2C clients, the starting point of technical, when you started, and to the point where you became huge and you started giving services to institutions, what was that journey like? And can you define it in steps so that someone who want to aspire to become one can also follow your step shoes?
Yeah, I think from what I've seen is that technical analysis is not a career, right? If this was the 1980s or the 1990s, Merrill Lynch had 26 technical analysts on their team. Now they have 2. The laws have changed. The Wall Street has evolved. So I think what gets lost is technical analysis being a career, when the truth is technical analysis is a tool, right? It's a tool that many people can use in their own ways. You know, if you are an analyst like me and you're covering different hedge funds and institutions and investors, those tools are great to be able to help them do their jobs better, which is my job, is to help them do their jobs better and, you know, manage my own portfolio and do better at that. So the skill of technical analysis definitely comes in handy. You know, if you're looking to make it a profession, you know, I would encourage you to write. And when you're done writing, write some more. Because what it really forces you to do is to really think through the entire concept. To be able to put it down on paper and write it down, you really need to think through it. So from as great as it is as a deliverable and people get to read it and learn and see your thoughts, that's great. But from a selfish perspective, the fact that it forces you to think through everything, I think is really, really powerful. So if I had any advice to anybody, is to write as much as possible.
What a beautiful thought you just mentioned. So principally, you are saying that it's a tool which should be adopted by everyone, maybe a trader, maybe an investor. The fact that you are giving services to hedge funds, and they are largely investors, right? There is a misconception that technical analysis means trading. Technical analysis can also be used for long-term investing. Am I correct?
Yeah, in fact, technical analysis is much better. More powerful the bigger the time horizon, you know, which is another, people are like, oh, it's just for short-term trading. It's like, I mean, it can be used for short-term trading, it is, but actually the support and resistance levels are much more powerful on larger time frames. And a true value add of technical analysis is the ability to use multiple time frames, starting from the longer term and then working our way down to the short term, as opposed to just looking at a short-term chart, right, and trying to identify trends. And let's remember what technical analysis is, right? You know, what we're doing as technicians is analyzing the behavior of the markets. We're looking for trends. So if you think something's in an uptrend, you're doing technical analysis. You know, if you're talking about market sentiment, that is technical analysis. If you're looking at seasonal trends, like this time of the year, the market does this, during that time of the year, the market, that is technical analysis. If you're analyzing the behavior of the market and market participants, as opposed to the goods and the services in which a market deals, what you're doing is you're practicing technical analysis. You're looking for trends. You're analyzing the behavior of the market. And I think it's crucial for any investor, regardless of their discipline, to incorporate technical analysis as part of that, because how else are you going to identify the trend of the market, right? How else are you going to manage risk without analyzing price? And those are the two most important things in investing: recognizing the trend and managing your risk. And without price behavior, you can't do either one of those.
That's I'm really enjoying this interaction with you. So, you know, value investors till date have always been away from price-based decision making. But of late, I have seen on Twitter and other platforms, people have started talking about price action, entry point, exit point. So you think that evolution of last 20 years in this field, has something new happened that suddenly even a value investor is looking at price, or it's a kind of a bull market phenomenon, so nothing to really change the trend here?
I think that technology has come a long way in the last 20 years. Throughout my career, I've seen it. I've had a front row seat. I'm an investor in some of these charting platforms. I'm partners with some of these charting platforms. You know, my mentors, my predecessors, they had to do all of their analysis on paper.
Yeah.
You know, they had to build their own charts. So they would spend as much time gathering the data as they would analyzing the data.
Yeah.
So now we don't have to do that. We can rip through 5,000 charts in an afternoon, no problem at all. Our predecessors couldn't do that.
Yeah.
So I think technical analysis has become much more widespread, much more utilized, because it's easier to do, right? Everybody has charting platforms on their computer. In many cases, it's free.
Yeah.
The problem is that most people don't know what they're doing with the chart, right?
Yeah.
So just because we get to skip the part of gathering the data, we all still have to analyze the data. And I think people get, too caught up in the indicators and the MACD and the RSI and the stochastics and the slow stochastics and the fast stochastic. I mean, there's a zillion indicators and you see the chart with like 10 indicators. It's like, which one of these is price, right?
Yeah.
So for me, I'm much more interested in less on the chart, fewer lines on the chart, fewer colors, really focusing on price, recognizing the underlying trend, keep it simple, stupid. That's really what it is for me. And I think a lot of investors where they get into trouble is when they start overcomplicating things.
Yeah. I think there are many people in this ecosystem who wants to complicate things. So that they can have their own vested interests up and running. But let's talk about your strategy, your style. I know there are two things which you are absolutely known for. One is the top-down approach of understanding the market and then finding out opportunities in stocks. And the other one is multi-time frame analysis. So let me just quickly start with the first part. How do you, in the today's circumstances where dollar is behaving in a certain way, crude is behaving in a certain way, can you lay down a path for us that this is the first layer of macro, and then you study this, and then finally you arrive at a stock which could give you a momentum?
Yep, that's exactly right. So the first thing that we want to do is identify what type of market environment are we in.
Yeah.
You talk about value investors, like there are people out there that consider themselves value investors regardless of the type of market we're in. Yeah. But if interest rates are going down, value is the last place you want to be investing. You want to be in growth.
Yeah.
And then on the opposite side, you have some people that are like, oh, I'm a growth investor. Yeah, being a growth investor is great when interest rates are going down, but when interest rates are going up, that's a terrible thing to be, right? You're much better off being a value investor. So again, I don't think it's wise. You could do whatever you want. We're all adults here. The way I see it is that rather than just pigeonholing yourself into, I am a value investor, I am a growth investor, I am an energy investor, I'm a tech investor, why don't you just be the investor that is best to be in that particular environment, right? Like you could play football during basketball season if you want, but it's basketball season. We're playing basketball, right? You're going to be by yourself over there losing, playing by yourself and playing football. So the first thing we want to do is identify the market environment that we're in. So and it starts with the bond market. This is a $120 trillion market. So you want to start with the biggest and the baddest market of them all, and that's bonds. And we had a target of 3% on the U.S. 10-year yield, and we just hit that in the last week. So what's been happening, while interest rates have been skyrocketing, bonds have gotten off to the worst start to the year ever, I think. If my calculations are correct, the worst start to the bond market of all time. So what happens when the biggest market in the world is getting destroyed, that's going to trickle into other asset classes, particularly the growth stocks that do the worst as interest rates are going up and bonds are selling off. So you've had the growth stocks getting crushed, right? Relative strength in the value names, but they're getting sold as well. And then why are interest rates going up? Commodities have skyrocketed, right? You look at the crude oil and heating oil futures just hit new all-time highs, unleaded gasoline, natural gas. You're looking at the base metals like copper and aluminum and nickel, all of those dripping, everything except gold, right? Everything except gold has been doing well, and silver is terrible also. But all of these commodities, all these inflationary assets have been doing well. Interest rates are going up accordingly. In addition, you're looking at inflation-protected treasuries relative to nominal yielding treasuries also making new highs. That is an inflationary environment. So we want to think about the types of stocks that do well and the types of stocks that do poorly in that environment. And then once we identify that, then we look at all the stock markets around the world. Then we look at the U.S. stock market. If we're talking about the U.S., we'll look at the Indian stock market. We're talking about India, but in the United States, we'll look at the S&P 500, Dow Jones Industrial Average, transportation, the NASDAQ, the small caps, et cetera, et cetera. In India, we'll look at the Nifty 500, Nifty 50, the mid caps, the small caps. We'll go sector by sector, Bank Nifty, Nifty Energy, et cetera, and break it down so that when we decide, okay, hypothetically, we like stocks, we like this sector, then we'll look at the different stocks in that sector so that finally, by the time we decide we're going to buy JP Morgan or we're going to buy Mahindra and Mahindra, they're 95% of the reason why we're buying JP Morgan or Mahindra and Mahindra has nothing to do with the chart of JP Morgan or Mahindra. It has to do with the fact that, in the case of JP Morgan, we probably like US stocks, we probably like financials, we probably like broker dealers, and JP Morgan is the best risk reward. In the case of Mahindra, maybe we like consumer discretionary, we like Indian stocks, we like autos, and then ultimately Mahindra is the best way to express that thesis, for example.
But JC, that's my question. How do you arrive at that? Like you just mentioned that, say, let's talk about Mahindra and Mahindra. So you say you liked Indian market. So you looked at Indian market chart and made a judgment that I like it. Then you like automobile or consumer discretionary. So how do you scientifically define your liking or disliking?
Well, it's scientifically and artistically, right? So we use the robots and we use the humans. Scientifically, we're looking at relative strength. We're looking at momentum readings, right? Those are probably our two scientific inputs. Proximity to new highs, which is basically a derivative of relative strength, right? So that's where the science is. From an art side, what we're looking for trends, right? We're looking for uptrends. We're looking for relative strength. If a particular, energy has been great, until yesterday. But energy, for the first 4 months of the year has been a great trade. Energy was the best performing sector of last year. Communications were the worst performing sector of last year. And what are we seeing this year? Energy is the best sector and communications are the worst, right? So trends persist, because that's why technical analysis works, Vivek, because markets trend. We know that. We have the data, right? We know it's a fact. People are like, oh, markets are random. No, they're not random. We know they're not random. We have the math. There's been a million MIT, white papers written about it, and just kind of common sense. You look chart by chart, they're going up for a while, they're going down for a while, they're going sideways for a while. There's a much higher likelihood for a market that's trending to continue to trend in that direction than for it to just completely change trends. It's not like first day of statistics class where you learn about the bell curve and the normal distribution. The market doesn't fall under a normal distribution curve. We know that. It's not random. Markets trend. That's why technical analysis works, Vivek.
Okay. So let me ask a very basic question to you. How do you define a trend in the market? Like in India right now, what is the trend going on, according to you?
Well, let's say the Nifty 50, the trend is sideways, right? There is no directional trade in Nifty 50. It's just been a sideways mess really since last summer. Just really hasn't done anything. Really in a range, Nifty 50, the upper bounds around 18,500 or so, just below 19,000, and then lower bounds right around 15,500. So what's the trend in the Nifty 50? Sideways. What's the trend in Bank Nifty? Same thing, sideways, right? Over the last year, what have we seen in Bank Nifty? Sideways trend, upper end of the range right around 42,000, lower end of the range right around 32,000. Bank Nifty's in a 10,000 point range. There's a higher probability outcome that it's going to continue to trade in a range than it is for just a monster breakout or breakdown. But we'll know if we start breaking 32,000 on Bank Nifty, the trend is probably down. If we start breaking 42,000 to the upside, right, last year's highs, that's probably a breakout. We're probably heading up towards 50,000, 57,000. So, but right now, Bank Nifty, Nifty 50, the trend is a lack of trend. It's a sideways trend.
So, JC, you mentioned trend. I'm sure you have some, duration in mind. Do you look at very broad 10,000 feet view on the trend? Are you looking at monthly chart or yearly chart to figure out that trend?
Yes.
Okay.
For sure. And that's where the multiple time frames comes in. If you look at Nifty 50, longer term, it's in an uptrend. It's a beautiful uptrend longer term. I mean, Indian stocks are in maybe the most beautiful uptrend of any trends around the world, particularly when you compare it to other emerging markets that have really gotten hit bad. China's a disaster. Russia is a disaster, obviously. Latin America has picked up this year, but has been a disaster for so long. So India's like in its own world of relative strength, particularly amongst emerging markets. So great. Long term, it's an uptrend. But what are we going to do with that's great. It's good to know. It's good to put that into context. But what are we going to do about that? That's where we break it down to the shorter term time horizon, where we're looking over the last couple of years. And what are we seeing? We're seeing a sideways trend. So it's a sideways trend, short to intermediate term, longer term, very longer term uptrend. But from a tactical perspective, from an opportunities, what are we doing this week? What are we doing this month? What are we doing this quarter? What are we doing now? There is no trend, sideways.
So again, please don't mind if I ask you some very basic questions.
No, please.
So long-term trend is uptrend given, and the current medium-term to short-term trend is a no trend. So basically, no trend means there is no trade, right? It's a no trade zone, or we can still find out opportunities to trade in a no trend zone.
Yeah, for me, that's where the options market comes in. Because what happens in a no trend zone, as you call it, is that traders are getting what we call chopped up. They're just getting chopped up. They're losing money. They're just making donations.
Yeah.
So there is a way to be on the other side of that trade, and that's by selling premium. And I know the options market in India is not as sophisticated as in the United States. You're looking at Bank Nifty near month contracts, and you're looking at Nifty 50 near month, and that's basically it with respects to liquidity. In the United States, where we can go out further out, we have options markets and individual stocks and ETFs and all kinds of stuff. What we want to do is we want to sell options. We want to collect that premium, because the traders that are getting chopped up, that are losing money, getting whipsawed, that money has to go somewhere. I'd rather go in my pocket. So those are the types of trades we incorporate in a sideways market.
Okay. So in sideways market, because India is quite rich in terms of derivative contracts, so there are around 200 stocks from various sectors and industries listed here. In fact, India is one of the largest individual stock derivative market. So there will be some stocks with high beta. They will still perform even though market is in consolidation or whatever, no trend zone. Now, as using your model, should I trade those stocks which are showing me signs of uptrend or downtrend, even though market is in a range?
Well, if a market's in a range, if the index is in a range and a stock is in an uptrend, that's showing relative strength.
Yeah.
Right.
Yeah.
We like buying stocks that are doing that. If the market is in a range and a stock is in a downtrend, that's relative weakness. Those are the types of stocks we want to be shorting. Right. So yeah, I think there's opportunities there. And then also, you mentioned, should I be doing it? Should I be doing it like this? Understand that everybody is different. Everybody has different time horizons, risk tolerance, and overall objectives. So while I might think that it is best to be selling premium in a sideways range and collecting that income, another trader might be like, this is great. I can buy it at the lows, sell it at the highs, buy it at the lows, sell it at the highs, and that's great. That's not for me. I'm not good at doing that. But other traders are great at doing that. And they're not good at selling premium. So I think it really comes down to your objectives on how you're going to execute. So you do the technical analysis, you identify the trends based on your time horizon, and then you express your thesis however it is that is best for you.
Sure. Now, let me come to relative strength, because that is my area of study as well for many years. And I always say that whatever I am today is because of that study of relative strength. So I have a model. I follow a mathematical model of finding out relative strength vis-a-vis market. So I have two questions there, which typically people ask me. When I am finding out relative strength of any stock, so there are 5,000 stock listed in India, large cap, mid cap, small cap. I typically benchmark them with Nifty, because I think Nifty is the most efficient index in India. That's my belief. Would you be in the same school of thought, or you would probably like to see small cap compared with small cap index, mid cap compared with mid cap index, and large cap compared with Nifty?
It's a good question. I think the answer is probably both. We do a lot of comparisons to the Nifty 100, believe it or not, because it's a wider range. Listen, you're gonna get very similar data. So let's just start there. Comparing small caps to the small cap index, definitely. Comparing the small cap index to the large cap index, definitely. Comparing mid cap stocks to mid cap indexes, for sure. Comparing them to the large, yeah. I don't think there's a wrong way to do it. In the United States, for example, we'll look at JP Morgan and we'll look at it relative to the S&P 500. We'll look at JP Morgan relative to the financials index. In the same way that in India, You could look at Bank Nifty relative to Nifty 50 or Nifty 500. You could look at Kotak relative to Bank Nifty, right? You could look at Axis Bank relative to Bank Nifty, Axis Bank relative to Nifty 50. So I think that you can do relative strength at a sector level, at an index level. In the United States, you can compare, a growth stock to the growth stock index, right?
Okay. So the second question is that what should be my time duration of figuring out the relative strength? Because what is relative strength? Basically, the price outperformance or underperformance vis-a-vis the benchmark. So what typically is the time you consider? I'm sure it's not daily, maybe weekly or monthly or yearly outperformance.
Yeah, I mean, it's the truth is it's both. It's multiple time frames.
Okay.
Right? What is the longer term trend of relative strength? Is this like, for example, energy had been an underperformer for 10 years, while technology and growth was an outperformer as interest rates were falling.
Yeah.
Now interest rates are rising and technology has been an underperformer and energy has been an outperformer. Now you could say energy's been outperforming and it's gone parabolic, JC. While that is true, when you zoom out and you see the relative strength in energy, we're in year 2. And historically, relative strength in energy lasts 10 years. Relative weakness in energy also lasts 10 years. So if we know from experience that these relative strength trends don't last a few weeks or a few months or even a few years, they last a decade, and we're in year 2, are we at the end of this? Or is this parabolic move short-term in nature but falls within the context of a much more structural relative strength picture, right? So just like we use multiple time frames for specific stock analysis or index analysis, when it comes to relative strength, it's the exact same thing.
Okay. Actually, I'm going to repeat my question because I need answer to this question probably more objectively. So I wanted an exact strategy which you will use to trade that relative strength, because sure, we will be able to get the outperformance or underperformance of broader indices or sector indices. But suppose if I have to trade, so typically when you think about trading, what should be the duration of a trade? And when you are trading for a longer duration, the relative strength, which is maybe outperformance for long period of time, in a short term, it may be underperforming and you may incur losses. So how do you plan your trade? That's a question which I wanted to get an answer.
Yeah, and the answer is going to be different for everybody. Because we all have different time horizons and risk parameters and everything like that. So for me, I'm looking out weeks and months.
Oh, okay.
I don't care what happens. I don't care what happens next year. I'll worry about next year. I mean, for me, I can't think that. I don't even know what I'm having for dinner tonight, Vivek, yet alone what the market's going to be doing next year. I have no idea. Now, in terms of day trading and swing, that's too short term for me. I'm not very good at that. So my sweet spot, which in my opinion is the easiest, listen, making money in the market is not easy, but the least difficult time horizon to make money is in that weeks and months period, trying to make money this quarter.
Okay.
So that's how I look at it for me personally. I know people who look much longer term than that, and I have very successful friends who look much shorter term, right? There's no wrong way to make money, Vivek.
Okay. So say, for example, a stock Mahindra & Mahindra. So I believe you talked about Mahindra & Mahindra because it is relatively outperforming the broader market. So that's why you mentioned that name.
I just mentioned it I didn't have a reason to mention it. I just mentioned it for the same reason I mentioned JP Morgan. But now that you mention it, M&M has been showing some relative strength, pushing up against new highs. Yeah.
So how do you approach a trade on M&M right now?
Well, first we want to identify the trends. We start with the longer term trend, and the longer term trend is up, right?
And the longer term trend is, sorry to interrupt in the middle. Longer term trend is you're looking at the daily chart or the monthly chart?
I'm looking at a weekly chart.
But
you can look at a monthly chart too. Yeah. You're going to get the same information, right? So the longer term uptrend that peaked in the summer of 2018.
Yeah.
Since the summer of 2018, we've had a correction. We're back to the highs, and we've really been correcting that major move in M&M. I mean, we went from 60 to 1,000. I mean, that's, what is that? Is that check my math, 20 times? I mean, whatever it is, a lot. 18 times, 17 times, a lot. So a multi-year consolidation of a 16, 17 bagger, yeah, I think it's justified. It's well-deserved. So now we've been going sideways for 4 years almost, and, we're waiting for a breakout. And if we're able to break out above 1,000, I think you buy it. In the meantime, there's nothing to do, right? So I'm interested in buying a breakout in M&M above 1,000, and maybe it happens next week. Maybe it happens next year. I have no idea. So for something like this, I would set an alert at 1,000 or 1,001, and as it's breaking out above that, I'm going to get a little do-do-do-do-do-do, and I'm going to be like, oh, what is a little do-do-do-do-do? And I'll look, and I'll be like, oh, there's Mahindra breaking out.
So that means you trade limited, but you trade only when the effectiveness is very high, right?
I want the best risk versus reward propositions.
Okay.
That's what I'm interested in. So I want to know that I'm wrong as quickly as possible. I don't want to be in something and find out 6 months later that I was wrong. I want to be in something and find out 6 days later that I was wrong, so I can move on to something else and not just keep wasting my time. So I'm looking for well-defined risk parameters where if I am right, I'm going to make 10 times, 20 times what I am risking. So if I buy M&M at 1,010, let's just say, and I put my stop at 998 below 10,000, that's 12 points of risk.
Yeah.
But if I do my math and I think that M&M goes to 1,300, well, I'm risking 10, 12 points, but I can make 300 points. I like that.
Okay. So you think M&M 1,000-point breaking will give you that risk reward, not the current shorter tenure, any kind of breakout which we are getting?
Yeah, I mean, it's messy right now. I think as market participants, I think it's important to recognize when something is messy. And something is absolutely, M&M is I mean, a lot of markets are messy. It's not M&M's fault. A lot of markets are messy, but, this one in particular, and if you take if you do the measured move and you take the Fibonacci extensions from M&M above 1,000, you're looking at about 1,450. So if we're above 1,000, I like it long. If we're below 1,000, I don't like it long. And, you got 45% of upside. I like that.
Got it. So can I assume that you are a breakout trader, or you also try to find out stocks for retracement opportunities?
Well, we want to be buying breakouts if the market is in an uptrend. If the stock is showing relative strength, that would be the better trade to put on. Right now, the market is not in an uptrend. No, very few markets are in uptrend, if any. So buying breakouts is not a good strategy, right? Mean reversion strategies, range-bound strategies, like I said, selling the wings, like we say it in the options market, selling the wings. Those are the types of trades that are working in this environment, which gets back to my earlier point. First, identify what type of market environment we're in, then decide what types of strategies and types of trades you want to put on, instead of just, hey, this is my strategy, this is what I do no matter what the market's doing. Like, that's no good.
Right. Fair point. So when we decide what kind of market it is, we look at multiple markets together and then make a judgment.
Right.
When do that judgment change? Is that one single action, event, or anything which happens in the market which changes the thought process, or it takes a lot of time, maybe a few weeks, for the market to change the trend, and then you change your strategy for the new trend?
So before we even enter the trade, we want to lay out the plan. And the first thing we want to do is decide, what does the market have to do to prove this thesis to be invalid?
Okay.
So some people are like, oh, I set my stop 5% below or 10% below or trailing stop. You're just throwing an arbitrary number out there based on your parameters. But I don't know if you investors have learned this by now, but the market doesn't care about you or your objectives or your risk. The market doesn't care at all. So rather than just putting arbitrary stop levels or trading losses, I'd rather establish what the market would have to do to prove my thesis invalid. Let's stick with this trade in M&M. Let's just say we break out, let's say in October. We finally break out, the alert goes off, JC buys M&M at 10.10.
Mm-hmm.
Well, I say, well, if we break back below the 2018 highs, then this is not a breakout. If my thesis is that this is a breakout and we're going to 1450, if we're not above the 2018 highs, it's simply not a breakout. We know that. So then I'll set my stop back below the 2018 highs, and if we fall back below that, that's it. Trade is off. We move on.
Okay. So
but we always want to establish the plan before you put the trade on, because once you're in the trade, then you can't think straight.
Yeah.
Right. And as humans, that is a flaw of ours. So I think it's important to, number one, recognize that flaw that we have as humans and implement systems to eliminate the risk of us making bad decisions because we are human, right? We want to eliminate that possibility. So a trader friend of mine, he says that he's not a trader, he's an order enterer, because he establishes the plan, he just enters the order and lets the market do what it does.
Fair point. So my question was more with respect to a broader view of the market. So as you said that right now market is in a no trend zone. When do that view change? When the trend emerge, which could be one day or one event, or could be few weeks when the trend will re-emerge, and then you change your strategy, right? So typically with your experience, what do you think? When does the market change the tangent?
Well, it's different every time, right? So like if we're talking about Bank Nifty, we're in a range, and we're in a range until that range breaks. So it could break to the upside and resume the uptrend, or it could break to the downside and start a new downtrend.
So, in terms of making a broader view of the market, when you do intermarket analysis, right? So, for example, dollar index right now is 104, right? And it has broken important levels. So you will continue to believe that the dollar trend is uptrend, and your strategy for stock like Mahindra & Mahindra will have that uptrend in mind? Or when do you change that mindset? Are you getting what I'm trying to say? Because you said that make a broader view of the market and then trade Mahindra & Mahindra. Market is in a range. I will avoid Mahindra & Mahindra trade because range market breakouts will not succeed. Okay. What I'm trying to understand is, when do you change your stance about the market? What triggers you to change the stance about the market and then go all in with trades like Mahindra & Mahindra or Reliance or any trade where breakout is easily available?
Well, let's start with the dollar.
Yeah.
The dollar has been very strong, obviously, and the dollar has had a very negative correlation with risk assets, particularly over the last 6 years or so. So as the dollar's been rallying, risk assets have been under pressure, particularly stocks, right? Now the dollar is back to those 2020 highs, which were also the 2016 highs.
Yeah.
The last two times that the dollar index has been here, the dollar sold off.
Yeah.
And on both of those occasions that the dollar sold off, stocks did well.
Yeah.
So when you're asking me, what are the things that I'm looking at to see changes in the overall market, I think the dollars is number one.
Okay.
Because of that negative correlation that we've had that's been so strong. So I think a weaker dollar will be a positive catalyst for risk assets.
Okay.
And then on that same note, no pun intended, but the US 10-year yield, the 10-year note yield, is back to 3%, which had been our target.
Yeah.
Last time 10-year yield hit 3% was in 2018, and rates came off. The time before that was 2013, and rates came off. So if rates do that again, and we get a bid in bonds, and we get some sort of stability in the bond market, that's going to ease up some of the, or in my opinion, it will ease up some of the selling pressure in those big growth stocks that have been getting hammered.
Yeah.
So for me, from an intermarket complex, from a global macro standpoint, coming into the week, what are the two things that I'm looking at? Dollar, 10-year.
Okay. Fair point. I understood now. What is happening to gold? Why is it not doing anything?
Because nobody wants it. It's not, and nobody wants it. It's not necessary. It's obviously not a hedge against inflation. Somebody made that up one day. I don't know who made that up, but it's obviously not true.
Yeah.
The real hedges against inflation are what have always been hedges against inflation. Commodities. Gold is more of a currency than a commodity. I think the market has proven that, particularly over the last couple of years.
Yeah.
It doesn't move with any of the other commodities. So it's hard to call it a commodity if it doesn't trade like a commodity. It trades like a currency. A pretty bad currency, too, for that matter. I mean, I guess anything that's not the dollar has been a bad currency, but for the most part. So it's probably, we'll give the gold bugs a pass on that one. But it's definitely not a commodity. The things that do well that are hedges, and Bitcoin is not a hedge against inflation either. It never has been. It obviously is proving that it's not now. What's a hedge against inflation? Inflation-protected treasury securities relative to nominal yielding treasuries literally are designed to protect against inflation, and they have, right? So we know that. And, things like energy and food and things like that, that is literally the definition of inflation, have done well. So those are the inflation hedges, not Bitcoin, not gold,
So what's your long-term view on gold? Because we Indians, we love gold. So we always want to get some perspective about gold.
I mean, it's hard to find a worse investment. It's hard, it's hard to find something that has acted so poorly over the last 10 years. I mean, any idiot could have made money in the last 10 years. Everybody made money. Except the gold bugs, right? Like everybody's making money. Like even until this year, even people buying bonds were making money. Even with the disaster this year, the bond investors are making more money than gold. Everybody's making money except gold. So what's going to change? Well, what's going to change? We need a breakout. We need a breakout from those 2011 highs. We're still below the 2011 highs, Vivek. It's 2022. We still haven't broken out. So gold had a major run off the 99, 2000 lows, major run into 2011, and it's taken over a decade to digest those gains, and I don't know how much longer it's going to take. It could take, maybe it never breaks out. I have no idea. But, if we're below the 2011 highs, if we're under 2000 in dollars and gold, there's nothing to do there. It's a bad trade.
Sure.
And then another thing that I'd like to say is the silver-gold ratio. So when precious metals are doing well, traditionally, silver is outperforming gold. It's the higher beta, riskier, crazy little cousin of gold. And we just haven't seen silver outperforming, which makes sense in an environment where gold's a bad investment. When gold's a good investment, you're probably going to see silver outperforming. We haven't seen any of that yet. So what are we waiting for? We're waiting for a breakout. Stay patient. Patience has been rewarded handsomely.
Yeah, true. I want you to look at the chart of USD INR.
The chart of which one?
USD INR. Rupee.
Oh, USD INR. Yep. Well, I mean, the dollar's been very strong, obviously. Rupee has held in relatively well compared to other currencies around the world. So that is for sure. And now dollar rupee is back to the 2020 highs. Where rupee bottomed out, right? That was like the peak of the pandemic, if you recall. When things were the worst, stocks were selling off, right? And that's where rupee bottomed and rupee started acting well and stocks did well from there. Well, now we're back to that level. So when we talk about the US dollar index back to the 2020 highs, you could throw dollar rupee in there as well. So if rupee's ever going to show any strength at all, it's going to come from these levels. So I'd be looking at that 78 level. If we start taking out 78 to the upside in dollar, rupee, and USD INR, that's probably really bad for INR, right? That's probably really bad for risk assets in general. Stocks are probably not doing well. So if you're bullish of stocks, I think you're looking for some rupee strength here for sure, whether you're an Indian investor or not.
Fair point. JC, I want to ask you this last question. I'm going back to your multi-time frame analysis and again going back to that Mahindra example, because there's still one question which is striking me. When you are making multi-time frame analysis, are you looking at a specific instrument multi-time frame as well, like Mahindra monthly chart, daily chart, and maybe hourly chart to figure out short-term trend and participate in the short-term trend?
I don't look at intraday charts.
Okay.
The shortest time frame I go in stocks is daily. I
Any
look at
specific
daily, weekly,
reason?
and monthly charts.
Any specific reason?
I'm just not a good day trader. It's
Okay.
it's too short term for me. I think it's much more difficult to be a day trader than it is to be an intermediate term investor like I am. I think that's the easier money to make. I like making my life easier. I don't like making my life complicated. I don't like being handcuffed to a computer all day. That's just not my lifestyle. I like to go out for a run, or go play with my baby for a little while, or get a coffee, or make a phone call. You know, I don't need to be locked down in the computer all day. That's not for me. I mean, I have plenty of friends that do that. That's great. It's just not for me. So I think part of investing is understanding yourself and the type of life that you want to live. Because remember, we don't live to work. We work to live.
Yeah, that's true. So, okay, so you will not look at intraday chart, but you will look at monthly chart of Mahindra and daily chart to figure out trading opportunities in daily chart.
Yeah, long-term time frames to get structural perspective, shorter-term time frames for tactical opportunities.
Okay, that's fair enough. Great. So, JC, I had this much time you gave to me, but I'm really glad that we did this. We discussed some basic concepts, but really you emphasized on those so much that my basic learners, because a lot of Elon Markets learners are very elementary basic learners, they will get a lot of wisdom from this video. Thank you so much, JC, for your time.
You got it. Thanks for having me.
Thank you. Bye-bye.